What is up, everybody? Welcome to the Monday Market Update. I am Sean Grapevine, a co-branch manager at the Atlanta branch of UMortgage, and I'm joined here by a man who needs no introduction, but who gets one anyway. He put the O in CDO. When the yield curve is inverted, he's completely upright. He likes his rate stack the way he likes his gasoline, extra premium. He's the first ever Goldman Sachs associate to be rated AAA plus by Standard & Poor's and Moody. He's the Baron of Bips. He's the Titan of the 10-year. He is the awesome Austin Koenig. Welcome, Austin.
Thanks, Sean. I appreciate it. Nice, new, fresh introduction. I appreciate you getting better every day. That's awesome. It's been great to see how this evolves over time. If anything, it's been great.
Thank you. I don't. It's just gets me going on a Monday, right? It really gets the juices flowing. Now I feel like I'm ready to take on the day. Speaking of the day, let's go over last week. Excellent segue there, John. Thank you. Tell us about the news last week. Tell us about rate movements. Tell us about anything we need to know about what happened and how it affects us.
Yeah, it's a great point. I think what really, when I'm thinking about last week, I think it's all a lot of positioning for what's to come this upcoming week. I think the one thing that stands out in my mind is we had a positive GDP print that slightly beat expectations, which crazy. We've had two prior GDP prints that were actually showing negative growth. Now, obviously, one thing to consider though is if your economy has shrunk to quarters in a row, growing the economy 2.6%, on an annual basis, still doesn't look as great because you're kind of starting from a lower point, right?
Mm-hmm.
But generally, when it comes down to it, that was a surprise. The thing that I think everyone's going to be looking for, of course, this week is what the Fed decides to do and what they talk about after. And we have a big rate decision on Wednesday, November 2nd.
Okay, so Wednesday, November 2nd, a day after the midterm, the midterm's this week or next week?
I think it's actually next week. The 8th is
week.
when that is. Yep.
There you go. Good call. So we've got two big things coming up. We've got the Fed decision, and then we've got midterms next week. So that should be sure to throw markets into tizzy. So coming up on Wednesday, the rate decision, do you think that what's actually going to happen is basically what people are expecting? Is there any is there much volatility in expectations here? Or are we all pretty much on the same page?
Great question. So I think there's a wide consensus here of 75 bips is what we'll see from the Fed. That raises the Fed funds rate from 3.25 to 4%. If we're looking at kind of where the market's pricing things or expecting things to go, we have one more meeting after this, and that would be possibly a 50 bip rate hike, essentially. That's what people are kind of pricing in. So we're having, if we get 75 bips like we think we are, that's going to be the fourth one in a row that's 75 bips, which is pretty unheard of for the most part. And then we have a 50 bip hike possibly coming after that. However, what the Fed says after the meeting on Wednesday, kind of the the post press conference after the decision that Jerome Powell always holds, that I think it actually carries a little bit more weight than kind of a Fed rate decision that meets expectations.
Sure.
Let's say if it actually is 75 bips, right? So I think what the Fed says after is going to be a little bit more, pressuring the market than anything, because that's where the market is really trying to price in where they think the Fed will go and when the pivot may happen. And so what I mean by pivot, that means kind of where are we going to stop tightening, and maybe take a look around and start actually even kind of easing conditions. If the economy were to get a certain way, or how's the Fed changing their view about how they're looking at data, if anything. Those are kind of different pieces of information that the market's looking for, because Friday we get jobs numbers.
Right. When do we get CPI?
CPI will be at least another week after that. I don't actually have the date on the top of my head, but it'll probably be sometime mid-November. So
are we worried that CPI stays in the 8s, that December rate hike could look like 75 bips, and it doesn't really seem like the market cares too much which direction. It's not so much is the Fed going to do what we think it's going to do? It's like when it does things aren't not sure that it's going to do, right? Like when they surprise us is when markets get super upset. Is that 50 bips kind of dangerous? Like, are we thinking that like it may be closer to 75? We still have 2 CPI numbers to go before it happens. Like, what are our thoughts there?
Yeah, that's a great point. So Sean, that's kind of exactly how the market has to digest things, right? Because what they know is this is what we think the Fed will interpret this data as in terms of how they go forward, right? And the market real time prices that in. So let's say we have a bad inflation print, that would possibly change the market's prediction for the December rate decision to maybe go higher. And so at that point, there's also opportunities for the Federal Reserve members to actually go out and speak to the market. But when it comes down to it, how they are kind of instructed to interpret the data by Jerome Powell and other members of the Fed is kind of the way that they will real-time price things when, let's say, CPI is going down way more than they thought it would be. Okay, then we'll price that in, and let's say jobs numbers come in a lot shorter or a lot hotter. There's a lot of different things that the market tries to price in, and that's why you'll see a lot of volatility because there's kind of just a lot of uncertainty because every different data point is changing almost like the weather. It's like now we're predicting rain or now we're predicting sunshine.
Sure.
This sort of thing is a factor for how the Fed's going to move next time. So that's really all the market does. Is 50, like if it goes to 75 bips to end the year, I think that would be a surprise for a lot of people, but I don't think it's at the same time. I don't think it's unlikely if we still see a lot of hot economy stuff. Yep.
Interesting. Okay, perfect. So we've got Fed rate decision here. We've got midterms next week. We've got then we've got CPI a little bit after that. So we've got a busy couple of weeks. It seems like once we're done with as soon as we're done with CPI, then we'll be 10 days away from PCE. Is that what it's called? PCP.
PCE, PCP.
Okay, all right. It might make you need some PCP. So all right. Well, tell me this. Okay, so this has been super helpful. And just having you around and your team at UMortgage has been amazing, especially coming over from the broker world, where like at best maybe you're getting like some tangential information from a Barry Habib type. So we're half broker, half correspondent, right? We're our own type of platform, but we're still dealing with wholesale investors, and we're on that mini core line. A lot of mini correspondents don't have a lock desk or secondary market or capital markets at all. And I'm so thankful that we do, but tell us like why it's important for us to have capital markets desk, why, when a lot of people don't have it, how that benefits us having you around. I know why it's beneficial. I just want to hear it from you.
Yeah, I think Sean, it's great. It brings up a great point, really. We were on a recruiting call last week. The weekly mortgage recruiting call, discovery call is what we like to call it.
Mm-hmm.
And I think we did a good job of explaining this to kind of that audience. But to reiterate, I think really what is beautiful about the UMortgage model is you have the flexibility of when you're maybe a broker where you have different lenders you can price to, and you have a lot of different options when it comes to products and everything like that. The thing that retail really excels at is the amount of support, right? Like the operations and they have their in-house lock desk and everything like that. So that's kind of like where we're trying to blend that sort of best of both worlds in a sense, where we're providing support into kind of the whole operations window to be able to lock the loans for you guys, as well as there's more risk, I would say, locking non-Del slightly more than brokering because there's no real margins baked in, and you need to make sure that everybody's actually making enough to even get themselves paid, or let alone make the company break even, if not make money. So
I don't know who could mess that up. Just kidding. We messed it up last month.
But at the end of the day, like that's one of those things why we exist, and it's among a lot of other things where we're working with our investors constantly. There's a lot of things that get done behind the scenes, working with providing analysis to where we're sending loans to over other investors to help them maybe provide better, sharper pricing to us on certain things such as incentives or different things that allow them to get
Right.
more volume.
Right.
Working with
And you guys, so you guys aren't really just a lock desk, right? I mean, you guys do have that role, but right, like every time, you guys are the dedicated sort of points of contact with our current lenders and then also new lenders, right? Every time we get a new product, it's you guys going out there talking to them about seeing if we're a good fit, and you guys sort of establishing whether or not like we have been within the company, right? If one person's requesting a certain type of loan, maybe not something that's worth like lifting for our entire company. But if 2 or 5 people are like, hey, can we get these, Alaska, FHA loans, like, and you guys, establish the need and go out there and find it. Is that right?
Yeah, no question about it. I think everything is a cost benefit analysis, right? And if we have a lot of demand behind a product, it's usually obviously one worth looking into, but two, finding actually a reliable partner that we can get that done with. And a lot of times what's best for us is being able to add or advise our, counterpart lenders, capital markets department, to be able to actually roll that said thing out instead of adding a new lender. For example, this past week, I was working with Remen a little bit in their capital markets department, seeing what they can do with a 3-2-1 buy down.
Yeah, when's that coming? That's a great, like, right. I think a couple brokers have rolled that out, or wholesalers have rolled that out. A couple retail, right? And we're getting questions from agents. You guys have 3-2-1, and it's like, I mean, who's really gonna be able to use a 3-2-1? But like, what's the status? What did Ribbon say?
Well, that's something that they're working on. I don't have an actual official ETA, but it's something I, contacted their capital markets department and found out they were rolling that out probably within the next month, sometime maybe in November. We might see that come out. Even, maybe an hour before they even know about it. So it's one of those things where it's not even necessarily, hey, I'm trying to beat them to it, but something that I have some contacts in their capital markets department.
It helps us plan and understand who has what, and who's
exactly
our needs.
Kind of the cost benefit analysis behind this is, should I train all of operations for a whole new lender portal, whole new system flow, all that sort of stuff, or is our lenders going to be able to actually provide us that same liquidity and that same product, and we don't have to do any of that huge overhaul in terms of training and everything like that. It just works better, if we're able to kind of lean on our partners and kind of advise them, hey, this is what some of your competitors are doing. We'd rather, continue some business to you guys. Here's, some of the products I think it'd be great to roll out, and there's actually demand behind it. And yeah, I agree. 3-2-1 buy down maybe is a select bucket of.
I mean, you got to be putting 10% down. Yeah, it's like it definitely. But I mean, like the more arrows in our quiver, especially if there's no additional cost to implement it, that's great.
Exactly right. Exactly right.
Well, okay. So for everybody who stuck with us this long, tell us this, Austin. Give us a sneak peek at the next exciting product, or can you do that? Do you have anything that you can spill the beans on coming up for the next quarter or so?
Well, I mean, I guess we can talk a little bit more about 3-2-1 real quick. That's one product that I know is kind of coming on the horizon. I don't really have like a special non-QM product or something crazy that's coming in, but I think just keep on the lookout for DPA as well. One thing that Windsor rolled out recently is kind of a different DPA program than I'd say most. And Andrew Keating on our team, he actually posted on this in Workplace. It's limited in geographic sense. So I'd say maybe around 20 states are eligible for this, but it's different than the Shinoa program. It's kind of one of those second liens that's provided by, this down payment assistance.
And it's conventional, right?
It's conventional too. Exactly right. So
we're actually having a training on that Thursday, or with all of Windsor, right? We're going to be talking about bridge loans, DPA, that kind of thing, this Thursday, 4 p.m. So keep an eye on Workplace, everybody, to check that out. All right, it's 10:15. It's time we all start locking some loans and burying Austin and his team in lock requests. Thanks as always, Austin.
Of course, thank you, Sean. I appreciate the time, and I hope everyone has a great rest of their week.
Yeah, absolutely. All right, everybody. Thank you so much for being here. See you next week.
See ya.